Linda saved for 35 years. She was a nurse, drove a 2009 Camry way past the point anyone thought was acceptable, packed her lunch every single day, never carried a balance on a credit card. She hit 67 with $1.2 million in her 401k, and she thought she had won. Her financial advisor told her, "Let it grow. Don't touch it until the IRS makes you." Standard advice. You'll find it on every financial website right now. Here's what that advisor forgot to mention. At age 73, the IRS is going to force Linda to start pulling money out, whether she needs it or not. And because her $1.2 million has been quietly compounding, she'll be sitting on roughly $2.3 million by then. Her first mandatory withdrawal? About $85,000. Add that to Social Security, add her small pension, suddenly Linda, who only has $1.2 million, has a taxable income over $130,000 per year. She's in the 24% bracket. Her Medicare premiums have tripled, and 85% of her Social Security is now federally taxable. Linda did everything right, and the tax code is quietly eating 30 to 40 cents out of every dollar she thought she had saved. That's not a Linda problem, that's a system problem, and tens of millions of Americans are walking straight into it, completely unaware. That's what we're covering today. I'm Tom. I've spent years reading IRS publications and actuarial tables that were never meant to be interesting. I have hundreds of thousands of dollars across tax-deferred, tax-free, and taxable accounts, built deliberately because I made every mistake I'm about to describe and got lucky enough to catch it in time.
Starting at age 73, that number moved from 72 under Secure 2.0 in 2022, you are required to withdraw a minimum amount from your traditional IRA and 401k every single year, no exceptions. The IRS has a table called the Uniform Lifetime Table. Take your December 31st balance, divide by your life expectancy factor. Withdraw at least that much. At 73, the factor is 26.5. On $1 million, that's a $37,736 mandatory withdrawal. Not catastrophic on its own, but watch what happens over time. At 80, the factor drops to 20.2. At 85, it's 16. The divisor keeps shrinking, and if your account is also growing, RMDs can accelerate faster than your spending. Let me run the real numbers on someone. Dave is 71, retired electrical engineer in Ohio. He has $1.6 million in his 401k and collects $2,800 a month from Social Security, $33,600 a year. Total income right now, about $43,000. He's comfortably in the 12% federal bracket. Life feels manageable. Dave turns 73 in 2 years. His 401k, growing at 6%, will be roughly $1.8 million. First-year RMD, $1.8 million divided by 26.5 equals $67,924. Add Social Security, $33,600, add his brokerage dividends, $9,400, gross income, $110,924. Now here's where it gets ugly. Because his income crossed a specific threshold, 85% of his Social Security benefit is now federally taxable. That adds another $28,560 to his taxable income. Suddenly, Dave's real taxable income is closer to $122,000. He just jumped from the 12% bracket to the 22% bracket. He didn't earn more money, he didn't get a raise. The IRS math changed what counts. IRMAA stands for Income-Related Monthly Adjustment Amount. It's what happens to your Medicare Part B and Part D premiums when the IRS decides your income is too high. Stay below $103,000 as an individual, or $206,000 as a married couple, and you pay the standard Part B premium, about $174 per month. Fine.
Cross that threshold by a single dollar, and your premium jumps by $70 per person per month. That's $840 more per person per year, $1,680 more for a couple. And the brackets keep escalating. At $161,000 individual income, Part B costs $454 a month. At $193,000, it's $559. At the top bracket, $500,000 and above, you're paying $594 per person per month, nearly $14,300 per year per person, just for Medicare Part B. A married couple at the top bracket is paying over $28,000 a year for Medicare premiums alone. The part that really breaks people's brains, IRMAA, is calculated on a 2-year lag. The premiums you pay in 2025 are based on your 2023 tax return. So if you had one high-income year in 2023, a big Roth conversion, a house sale, a large RMD, you're paying elevated Medicare premiums in 2025 and 2026. Most people don't realize until the bill arrives. This is how wealth quietly transfers, not through scams, through complexity applied at scale to people who are busy living their lives. Here's the third landmine. If your combined income, your AGI plus half of Social Security plus tax-exempt interest, stays below $32,000 for a couple, none of your Social Security is taxable. Zero. Between $32,000 and $44,000 for couples, up to 50% becomes taxable. Above $44,000, up to 85% of your benefit is taxable. Here is the specific absurdity of those thresholds. They were set by Congress in 1983, and Congress has never adjusted them for inflation. In 1983, they caught only wealthy retirees. Today, with larger Social Security benefits, larger 401k balances, and mandatory RMDs, the overwhelming majority of retirees with meaningful savings end up with 85% of their Social Security benefit taxable. The thresholds were designed to tax the wealthy. They now catch the middle class. That's not a bug. That's the system working exactly as Congress designed it, because they never updated the numbers and nobody made a fuss.
If you're under 50, build tax diversity now. Always contribute enough to capture every dollar of employer match. That is the highest guaranteed return available to you anywhere. But above the match, think carefully. Does your employer offer a Roth 401k? Use it. You pay taxes now. Everything that grows is yours tax-free forever, with zero RMDs. If they don't offer it, open a Roth IRA. Income limits are $161,000 individual, $240,000 for couples in 2025. Above those limits, look at the backdoor Roth. Make a non-deductible traditional IRA contribution and immediately convert it. IRS approved, requires a Form 8606, creates permanent tax-free wealth. The goal is 3 buckets: pre-tax accounts like traditional 401k and IRA, tax-free accounts like Roth IRA and Roth 401k, and taxable brokerage accounts. Any advisor who only talks about one bucket is telling you half a story. If you're 55 to 72, use the most valuable window you'll ever have. This window is the entire ballgame for retirement tax planning. You've stopped working or reduced income. You haven't hit RMD age yet. Your income is potentially at its lowest point in 20 years. Do Roth conversions. Every year, calculate your taxable income. Identify how much room remains before crossing into the next bracket. Convert that amount from your traditional IRA or 401k into a Roth. Pay the conversion tax from money outside the IRA, from your brokerage or savings. Every dollar of tax you pay from outside the Roth is a dollar that keeps compounding tax-free inside it.
A couple in the 22% bracket with $60,000 in other income might have $20,000 to $30,000 of conversion space per year. Do that for 8 years and you've moved up to $240,000 into a tax-free account. $240,000 that won't generate an RMD at 73, won't trigger IRMAA, and won't push more of your Social Security into taxable territory. This window opens once. The best time to start was 5 years ago. The second best time is this week. If you're already past 73, use the QCD. Almost nobody uses this, and it's genuinely one of the most powerful moves available. It's called a qualified charitable distribution. If you're over 70 and a half, you can direct up to $105,000 per year from your IRA directly to a qualified charity. That amount satisfies your RMD requirement, but it does not appear in your adjusted gross income. It doesn't push you further into the Social Security threshold. It doesn't trigger IRMAA. If you already donate to a church, a hospital, or any 501c3, the QCD combines your required withdrawal and your charitable giving into one move and saves you income tax on every dollar you redirect. At any age, model the real number. Find a fee-only financial planner, flat fee or hourly, not assets under management, and ask them to model your projected RMD exposure, not your projected balance, your projected tax bill. Show me what my RMDs look like at 73, 78, and 83. Show me where the IRMAA cliffs are. Show me what Social Security taxation looks like under each scenario. This is a one-time planning conversation, not ongoing management. You can do it once for a flat fee and have the information you need to make decisions for the next decade.
3 things to take with you. Your 401k balance is not your retirement number. Your after-tax 401k balance is. Every dollar in a traditional account has a tax liability attached that hasn't been collected yet. Run the real math. It includes the IRS, Medicare, and Social Security all showing up at the same time. The window between 65 and 73 is the most valuable tax planning opportunity most people will ever have, and most people waste it by doing nothing. 8 years of Roth conversion capacity at favorable rates before the IRS takes the wheel at 73. That window opens once. The 401k is a genuinely powerful tool. I'm not telling you it was a mistake. I'm telling you it was sold as the whole story when it was actually just the first chapter. The second chapter involves the IRS, Medicare, and a 40-year-old set of thresholds Congress never updated. Understanding that doesn't mean you reject the account. It means you build around it deliberately. Linda drove a 2009 Camry past the point anyone thought was okay. She packed her lunch for 35 years. And she's going to be all right, but she's going to pay significantly more in taxes than she planned, because nobody showed her the second half of the story, because the system isn't designed to show it to you. The people who come out of retirement in the best shape aren't the ones who saved the most. They're the ones who thought about what happened after the saving. They modeled the RMDs. They planned the Roth conversions. They knew where the IRMAA cliff was before they fell off it. Don't be the person who finds out at 73 what the back of the brochure said. The information is here. The window to act is limited. Go check your projected RMD exposure this week. Use the calculator in the description. Talk to a fee-only planner. Do the actual accounting before someone else does it for you on their schedule. The math is easy. The execution is the work. And the best time to do that work is before the IRS decides for you. Subscribe if this helped you see the second half of a story you've only been told the beginning of. Peace.